You ever wonder what really separates the winners from the losers in business? Why some companies just take off while others stumble?
Yeah, it's a big question, a fundamental one, really.
Well, today we're diving into something key, business valuation. It's like the lens you need to see how companies really build value.
Or sometimes how they destroy it, right? Which is just as important to understand.
Exactly, or destroy it. So this is sort of your shortcut to getting those aha moments about what makes a business tick, financially speaking.
And we're not gonna, drown you in complex formulas or endless spreadsheets. That's not the goal here.
No, definitely not. Keep it accessible.
Our focus today is pulling out the core ideas from, well, what's pretty much the gold standard text on this subject.
Right, the valuation book. Collar, Goodhart, and Wessels.
That's the one. Valuation, measuring and managing the value of companies. 7th edition now, so it's got layers of wisdom, building on Copeland and Murren's earlier foundational work.
Quite the pedigree.
It is. And our goal really is just to give you the essential principles, the big picture on valuation without getting lost in the weeds.
Okay, let's jump in. So, the core idea, what actually makes a company valuable? It's not some newfangled concept, is it?
Not at all. It's surprisingly timeless. You can go way back to Alfred Marshall, like 1890.
Wow, really?
Yeah, he basically said a company creates value when it grows, sure, but crucially, when the return it makes on its investments, its ROIC, is higher than what those investments actually cost, the cost of capital.
Seems pretty logical when you put it like that. Earn more than you spend, essentially.
It does. Simple concept. But, and this is the fascinating part, history is just littered with examples where people completely lost sight of this.
Oh, yeah. Like what?
Think about tulip mania back in the Netherlands centuries ago.
Right, the tulip bubble.
Or more recently, the dot-com boom and bust around the turn of the millennium.
Yeah, I remember that one vividly.
And even the real estate craziness in the mid-2000s leading up to the financial crisis.
So different markets, different assets.
Totally different on the surface.
Yeah.
But underneath, a lot of it came down to ignoring or maybe just misunderstanding that fundamental link between return on investment and the cost of that investment. People got caught up in the hype.
A good reminder that fundamentals matter, even when things seem wild.
Absolutely. Easy to forget in the heat of the moment.
Now, it's not just about the shareholders, the owners, is it? There's this whole discussion about stakeholders. Employees, customers, communities.
That's a really important point, and it's gotten a lot more attention lately. You had the Business Roundtable statement in 2019 acknowledging that broader group.
Right.
But the book argues, and I think it makes sense, that when you focus on creating sustainable long-term value, that usually benefits all stakeholders in the end.
How so?
Well, a company that's creating value is generally healthier, more stable, probably growing. That's good for employees, good for suppliers. It means resources are being used efficiently, which helps the overall economy too. It's about the long game.
Okay, so prioritizing long-term value isn't necessarily ignoring stakeholders.
Not if it's done right. It should lift everyone.
Got it. Let's make this concrete. That term you mentioned, ROIC, return on invested capital, how do we measure that? Say, for a small business like Lily's Dresses.
Okay, good example. Lily and Nate, running their dress shop, they want to know if they're actually making good money on the money they've put into the business.
Yeah.
ROIC is the way. Simply put, you take the profits they make after taxes, their operating profits, and you divide that by the total capital tied up in the business.
And that capital includes?
Things like the money tied up in their inventory, all those dresses, plus the shop fittings, maybe the building if they own it, computers. Essentially, the operating assets minus the operating liabilities.
Yeah.
Chapters 10 and 11 in the book really break down the calculation details.
Okay, so profit divided by the investment needed to generate that profit. It's like an efficiency measure for their capital.
Exactly. For every dollar they've invested, how much profit is it generating each year?
Can you show why a high ROIC is so much better? Maybe with an example.
Sure. Let's imagine two companies, Value Co. and Volume Co. Okay. Both decide to invest, say, $25 million this year.
Okay, same investment.
Right. Now, Value Co. invests smartly, manages things well, and that $25 million investment leads to an extra $5 million in after-tax operating profit.
So $5 million return on $25 million invested, that's 20%.
Exactly. A 20% ROIC on that new investment. Now, Volume Co. also invests $25 million. But maybe they're less efficient. Maybe the market's tougher. They only get an extra $2.5 million in profit.
Half as much. So their ROIC is only 10%.
Right. Same money invested, but ValueCo is creating twice as much profit from it. That difference really drives value creation over time.
Okay, that makes it clear. ROIC measures the profitability of the investments. How does this then link up with growth and ultimately the cash a company generates?
That's the next step. Growth is great, but it's growth combined with a good ROIC that really throws off cash.
How does that work?
Think about it. If your ROIC is higher than your cost of capital, meaning you're earning more on your investments than they cost you, then every dollar you reinvest into growing the business creates even more value. You generate more profit, which means more cash flow available to, well, reinvest again or pay out to investors.
So high ROIC makes growth more valuable.
Precisely. Low ROIC growth can actually destroy value if you're earning less than your cost of capital.
And there's a formula that pulls these together, right? The value driver formula.
Yeah, it's a neat little shortcut. It's basically a simplified way to think about a full discounted cash flow or DCF valuation, assuming things like growth and ROIC stay constant.
And what does it show?
It shows that a company's value is driven by its NOPAT, that's net operating profit after taxes,
Okay.
divided by the difference between its WACC, weighted average cost of capital,
The cost of its funding.
right, and G, its expected growth rate. So NOPAT divided by WACC minus G. It highlights those three key levers: profitability, cost of capital, and growth.
Handy conceptual tool. Does the book connect this to actual stock market performance?
It does. There's research cited, Exhibit 3.9, looking at total shareholder returns, or TSR, over different periods, and the results are pretty interesting.
What did they find?
The companies that delivered the highest TSR, the best stock performance, were the ones that managed to grow the fastest while keeping their ROIC high. No huge surprise there, maybe.
The winning combo.
Exactly. But here's the interesting bit. The second best group wasn't the slow growers who improved their ROIC. It was the companies that grew really fast, even if their ROIC slipped a bit, as long as it was still decent.
Wow. So fast growth, even with slightly less stellar returns, beats slow growth with improving returns.
In those studies, yes. It suggests that achieving significant growth can be a really powerful driver of shareholder value, maybe more powerful than just incremental improvements in profitability, assuming the baseline profitability is okay.
That's quite a finding. But there's a danger there too, isn't there? Trying to just grow your way out of a fundamentally weak business.
Absolutely. That's a critical warning in the book. Some companies think, oh, our returns are low, but if we just get bigger, we can spread our fixed costs and become profitable.
The grow into profitability idea.
Right. And the book argues that unless you're a very small startup, maybe, that almost never works. Low ROIC usually signals deeper issues.
Like what?
Could be a tough industry structure, maybe a flawed business model, poor execution, something fundamental. Trying to grow before you fix that problem. You're usually just making a bigger version of a value-destroying business.
So fix the core profitability first, then step on the gas for growth.
Generally, yes. That's the much safer path to value creation.
Okay, that makes sense. So we have ROIC measuring the return, growth amplifying it. But the other piece is the benchmark, the cost of capital, or WACC. What exactly is that?
The cost of capital is, well, it's essentially the minimum rate of return a company needs to earn on its investments to satisfy its investors, both debt holders and equity holders.
So it's the hurdle rate.
It's the hurdle rate, exactly. It's the rate you use to discount those future cash flows back to their present value. And it reflects two main things. The time value of money, $1 today, is worth more than $1 tomorrow.
Right.
And the riskiness of those future cash flows. Higher risk generally means a higher cost of capital.
And it's not just the interest rate on debt, is it? It's broader than that.
Much broader. It includes the return that equity investors expect too, which is usually higher because equity is riskier than debt. And importantly, it's an opportunity cost.
Opportunity cost.
Meaning it reflects what those investors could earn elsewhere by investing in other companies with a similar level of risk. If your company isn't offering a competitive return for its risk level, investors can and will put their money somewhere else, especially for publicly traded companies.
That option is always there for them.
Always. Now, an interesting point the book makes is about which risks actually affect the cost of capital. It argues that only the risks investors can't diversify away, systemic market risks, should really impact the WACC. Company-specific risks, things that can be diversified by holding a broad portfolio, those should ideally be reflected in the cash flow forecasts themselves, maybe through scenario analysis.
So if I own, say, 50 different stocks, the risk of one specific company having a bad quarter is less critical to my overall return.
Precisely. You've diversified that specific risk away. And because